So I'm super excited to bring Phil on. And this whole conversation around impact investing, ESG strategy, I really looked hard, got some referrals, got touched into Phil. And Phil's a CFA, and if you don't know what a CFA is, it's a very difficult thing to get. Plus, he's a CFP. So prior to founding Impact Metropolis, Phil was the founding partner, served as Chief Investment Officer at Cornerstone Capital Group and RA, where that over $1 billion in assets under management. Currently, Phil serves on the board of the Excellent Committee of Calvert Impact Capital, formerly Calvert Foundation. He recently served on the board and the executive committee of USSIF, the Forum for Sustainability and Responsible Investment, and was the treasurer of the SIF Foundation. Phil has also recently completed a term on the advisory council to the city of Denver on sustainability by appointment of the mayor of Denver, and chaired the finance committee. So Phil, it's super great to have you in the program, and we just welcome you and thank you for being here and adding a whole lot of value around this great subject of ESG. Welcome.
Thank you. Pleasure to be with you.
Yeah, so let's kind of jump right into it. We've got about 45 minutes, and you and I've kind of talked about what we're going to cover, but this is also a good time for our audience if anybody wants to ask any questions of Phil. He's, again, a CFP plus CFA, but this whole movement of impact, I mean, I think the world today, in the way that people are starting to look at their portfolios, kind of describe what you really consider ESG to be today.
Well, ESG is an acronym that stands for environmental, social, and governance factors. And I would say that astute investors have considered governance factors in their investing approach since the beginning of investing. Governance factors are just some of the same kind of quality measures that you just referenced when you're selecting a manager. You want to see good governance in the investments that you make. I think what's been maybe behind the movement of ESG investing or impact investing or sustainable investing that's gone by different names over the number of years that the field has been around and evolving. But I'd say that people's awareness of environmental risks and also social justice issues come into play as risks to the investment performance of your portfolio, and as well, people want to invest in ways that are aligned with their values. So ESG is a way to express your worldview preferences through your investment portfolio, and it can be done in a way that doesn't sacrifice on financial return. In fact, may drive outperformance. So that's why it's been growing lately, because I think people, and you can just see what's going on in the world today. It's a very topical issue right now. You saw that oil prices went negative a couple of weeks ago. That is partly a function of the world moving away from fossil fuels, and that is an investment risk to people's portfolio if they're not aware of how these environmental, social, and governance factors will impact their security selection.
Is this just a continuation of, in the late 90s, it wasn't called ESG then, it was just, I don't want to own any sin stocks. Is this just a continuation of that? It seems different to me. I grew up in the business, I've been around since 95, and so this is a different level of movement. Do you agree with that?
Yeah, I think it is an evolution of the movement. I would say that, the movement goes all the way back to the beginning of investments. You can trace into sort of the traders back in the very beginning days of the colony of New York being unwilling to invest in the slave trade. That was an exclusionary decision made back then. And first, to not invest in something that was legal at the time because of a values abhorrence that those investors had. They wouldn't, some religious investors back then wouldn't invest in slavery, wouldn't invest in the military trade as well. So that's the very early days of it. I would say the modern incarnation of this really started with the South Africa divestment movement in the early 80s. That's when people sort of realized that they could use their investment portfolio as a way to express their displeasure with the apartheid situation in South Africa. But it was a coordinated boycott back then, which combined its private capital intention with support from different governments that were also willing to join in boycotting the South Africa government. And sort of media was behind it, academia was behind it, so everyone got behind it. So it was a very effective tool as a boycott then. Where the field went from there, though, was that people sort of discovered that they could use their investment portfolio as a tool to express their political or worldview from a values perspective. And so they started screening out lots of other things like tobacco, gambling, alcohol, nuclear power, lots and lots of things. So it was primarily an exclusion-driven approach. And exclusion, people still exclude certain things from their portfolio today if they're not comfortable with those investments, either from a values alignment standpoint or, because they think it's not going to deliver investment results. If you look at the performance of Exxon, for example, in the last 5 years, you just compare Exxon. If you throw Exxon up on a chart next to the S&P 500, you don't have to be Ralph Waldo Emerson to say that's just a bad investment. You could be an environmentalist, of course, and not want to invest in fossil fuels for very defensible reasons relating to their climate change denialism. But you can also look at it as just a poor investment, relatively speaking. So I think what's happened, though, is that the field moved away from a strictly divestment approach in the mid-90s towards more of a shareholder engagement approach, which is the opposite of divesting. You hold certain securities intentionally, in this case, in order to engage with those companies. And there were some very high-profile successes from the shareholder engagement approach, including having Nike sort of move away from sweatshop labor, having Home Depot move away from cutting down old-growth forests. There's still the Say on Pay movement was a successful sort of outcome from an active shareholder environment. That was the 2.0. I'd say the 3.0 that's really come up in the last few years is a sort of moving away from either divestment or shareholder engagement and more towards a sort of disruptive new industry approach. What's innovative? What's out there as a company that can be disruptive to an existing industry in a way that drives a positive social or environmental outcome as a result of the product or service itself? And I would not hold out the company Tesla necessarily as necessarily like the best governed company in the world. But I do think that that's an example of a company that showed up and had a totally different approach to electric vehicles, created a market. It was very disruptive. It's got a market capitalization now that exceeds all the other auto companies by a long shot. Beyond Meat is another one. Nobody would have thought 10 years ago that you could dwarf the size of the major meat manufacturing companies by using a plant-based meat alternative. But that's what's happening now, is people are looking for more sort of baked into the business model approaches that are either regenerative or sustainable or delivering a better solution than what's been there in the past.
How does, you're always, balancing return. And I don't know if I remember this correctly, but I think when you excluded in the late 90s the sin stocks, you did that, and you sacrificed performance, and people got very impatient with that. In the ESG world, how do you? We're really only dealing with the last 3 years. Is that correct? 3-4 years in terms of data?
No, I think the data goes back, and I think if you really look at if you do a real careful performance attribution of some of the providers of investment products in the late 90s that were relying heavily on exclusion, it used to be, the common sense used to be, well, if you exclude a whole range of securities that have the potential to perform well, at least in certain environments, then you're just going to skew your risk reward profile overall, to a worse position. That's sort of the common sense of that. But it's up, there are highly correlated securities that can be purchased in exchange for specific ones that you don't like. So, for example, if tobacco is a consumer staple, and if you're not comfortable with owning tobacco, you can own other consumer staple stocks that would have similar performance characteristics to tobacco. So the exclusions themselves, I wouldn't say drove the underperformance that you saw in those days. It was just that there weren't that many options out there back then. Index investing was not a big thing back then. And so it was just a case of maybe certain managers not doing a great job on security selection or rotating into similar performing substitutes when they did exclude certain things. I would say that nowadays you can do a passive investment approach that screens out quite a lot from an index like the S&P 500 or Russell 1000 or those other main indexes. You can exclude quite a few of those and still have create a portfolio that will perform with a very high correlation to the benchmark, like within less than 1% of difference. So, I think ESG data also has, I would say, a challenge if you're going to be super short term about how you look at it, because a lot of the issues that people care about from this environmental or social perspective may take years to play out. We don't really know when people are going to finally say, oh my gosh, we really do need to step up our pace of getting out of fossil fuels. But look at the coal industry. I mean, it did happen to them. And all the coal stocks are, either bankrupt or down 90% from their peak. Again, they're not good investments. And it's not because, the government said you can't have coal. It's just because renewables got cheaper. They're a better solution overall. And so, people just wisely migrated to the better solutions. So I do think that will continue.
Now, I don't know if you have this data or not, but in terms of the popularity of ESG, are you seeing that at the individual, family office level, or is it migrating into pension endowments and public funds?
Well, it's definitely migrating, and it's certainly one of the, if not the fastest growing part of the financial services asset management ecosystem right now. There's every single asset manager out there is trying to figure out a way to address the sustainability conundrum, because they know that that's where the marketplace is going. People want more sustainable, better investments that will survive the long run. And so I said the old days common sense was, if you screen out certain things, that's going to be bad for your portfolio. The current day common sense is, if you don't have well-governed companies that, if you have a company that relies on polluting the ocean as part of their intrinsic value as a company, or if you have a company that relies on just smokestack pollution or dumping waste into the environment, that's not a good long-run sustainable company that most people are going to want to invest in going forward, I would argue. And I think the statistics certainly bear that out. The amount of money going into ESG or sustainability-focused funds has been increasing relative to the broader markets. The performance of ESG funds during the recent downturn outperformed the traditional investments, partly because of the price of oil crashing during Q2. But it wasn't solely due to that. It was also due to Goldman Sachs had a report out recently that attributed most of the outperformance that was seen in ESG funds to greater ability to support workers, and that supporting your workers and having a happy workforce and a motivated workforce is it's a good governance issue that and companies are rated on that, and so the companies that had better ratings on that were the ones who outperformed during the downturn.
You gave me a couple of slides, one of which is, I'm going to have Tyler throw that up. And so can you walk us through this?
Sure. Make sure we're looking at the same slide. Which slide are we?
It's the real world impact, the sort of the cube. Can you see it on your screen?
Yeah. Yes, this is one of my favorites. So in traditional investing, people would look at the cube on the left, a risk-return trade-off. And you were just talking about it. Of course, that does make sense when you take greater risk with your portfolio, you should expect to be compensated with greater return. And if you're not willing to take greater risk, then you shouldn't expect to have higher return. So there is a, excuse me, there is a traditional trade-off between risk and return. But I think people are starting to understand now that there's actually a third dimension to this trade-off, which is impact. So there's not only risk and return, there's also risk and return and impact. And so every investment has impact. Some people don't count it well, or they don't choose to focus on it, but it is still being made. Some people are much more intentional and thoughtful about what kind of impacts they're making or would like to make. So thinking about it in a more three-dimensional way certainly adds a lot of complexity to your decision about how to manage your portfolio. I have to admit that, but I think it's worthwhile to address what kind of impacts you are hoping to make and be thoughtful about what kind of impacts you are making and ensure that your portfolio is not working at cross purposes to the impacts that you would like to see. In answer to your question before about where the assets are coming from into the space, it's certainly families, family investors, family offices, and foundation endowments are sort of the low-hanging fruit for this space. It always has been because they're mission-driven. Foundation endowments, donor advised funds, those are, or private foundations, those are all mission-driven by nature. So it's just nonsensical to have a certain mission that you're granting money out to try to deal with, and at the same time you're investing in such a way that's counter to your mission. Like, why would you, like, if you're a foundation that's focused on health, how could you justify investing in unhealthy products that are unhealthy by nature? It doesn't make any sense. So, and you don't have to. So just understanding those impacts, measuring those impacts, as well as the risk reward trade-off, I think is sort of where the field is going now, for sure.
Versus maybe just as a, endowment foundation, just investing in the S&P 500 and not screening out those particular categories for, whatever reason. It's I thought it was fascinating how I got to Phil, as I was referred to him by the CEO of Abacus Wealth Management out of Los Angeles, and they were really mandate is to bridge that gap or the between investing in the values of the family, and I thought that was just an amazing mandate. So you talk about a little bit that, but by doing this adds some complexity. So how do you do it in a way that either eliminates the complexity or, I just went through, I think you probably heard a little bit of my active discussion. I mean, as a CFA, you're well versed in all that. It's not an easy process to hire strong active managers. But so how does somebody go about navigating this landscape of ESG, because it resonates with them?
Well, I would say, as with any investment process, you start with your planning, and you just start to think through what it is you're trying to accomplish. So, if you go back to your investment policy statement, and hopefully any investor, if they don't have a full-blown investment policy statement, at least has some kind of plan in place to identify what sort of portfolio structure they're going to try to commit to, because it is hard to stay committed to your plan when the markets start acting sort of unusually as they have in the past few months. It's the kind of thing where your plan should guide you through this sort of period, ideally. So it's a good plan should be something you can stick with over through thick and thin, more or less. And I would say, starting out with an addition to that traditional financial model of identifying what kind of rate of return you're targeting, what kind of risk you're comfortable taking, what your time frame is for starting to pull money back out or needing cash in the future, whatever those expenditures are. Those are kind of the key elements of an investment plan. I would say it's just imperative to kind of start out with adding in that values piece, or how you want to approach ESG. You can approach it from an alpha seeking standpoint, and you can also approach it from a values driven standpoint. That's a fork in the road for people. So I just think people should start out getting comfortable with why it is they're doing this. Is it because they think that these issues are not as well understood by Wall Street as they could be, and therefore it's a chance to drive alpha? Some people certainly do look at it that way, and it is conceivable that the new common sense, as I just put it, will drive outperformance over time.
I think I love what you just said. That you drew a distinction between alpha and values. And so I actually had a chart, I don't know if you saw it, but I call it a hierarchy of investment priorities. And whatever it is, whatever the list is, you got to rank what's most important. And, there's a 1 and there's a 2. There's not 2 ones. So I love what you said because, people will say, I could just hear this. I want to invest based on my values, but I want alpha at the same time, and they'll be very impatient for that alpha. I mean, thank you for saying that.
Yeah, they're not necessarily in opposition. It depends on what your particular approach is, and it's going to be different in different asset classes. So if you're targeting climate change, for example, you can address that quite directly through large cap US or developed market securities. If you're trying to target community development and place-based investing in your own community, that's a different kind of value that is difficult to express through large cap securities. And you're going to have to move into the alternative space or some fixed income products to really target that value. So yes, I think understanding what your values are, though, and what you're after is the first step. How you're going to implement those is the second step. So, and your implementation might be different in different asset classes, and your expectations for how you're going to implement and what kind of outcomes you're going to be able to achieve realistically may also be different in different asset classes. So, that's kind of your second step. Your third step is then to source some actual strategies or asset managers, for each asset class approach, and you will find different. There is a robust sort of ecosystem of asset managers out there now who focus on trying to deliver different types of environmental, social, and governance good outcomes in different asset classes. So you can find U.S. large cap managers, you can find active and passive approaches, you can, international, large cap, small cap, developed markets, emerging markets, equity, fixed income. All manner of alternatives, private equity, hedge. They're all there with a sustainability approach these days. But you just have to find managers who are managing to a philosophy and style that fits with yours, and that you're on the same page with expectations around risk, reward, and impact.
Is it so you talk about it's available across all categories. I would imagine that when you get into some of the smaller categories, small cap and international and emerging market, the choices begin to narrow. It seems like there's a robust offering with large cap and either index or passive. Is that kind of what you're seeing?
Yeah, I think that's fair. I think there are probably fewer options in small cap compared to large cap, just because large cap has had longer. There's been a greater effort to address that. That's where most of the money is. Something like 90% of the total market cap is tied up in large cap. So, that's where people started. And but as you noted, people diversify across different asset classes, and they want to see solutions. For people who do sort of buy into the impact mindset, some people who do say, okay, let me really consider my impacts in the world with my money, and let me think about my capital, my investment capital, as another lever that I can use to impact the world. And let's say you have a philanthropic foundation and you use that grant capital to impact the world a certain way, and you think, I want to build a bridge to my investment capital, and without sacrificing on my intended return in the investment side of this, I still want to have that same intentionality though. How do I apply it? You will find opportunities to apply it, most likely, assuming that you have sort of normal or a little more widely agreed impact intentionality. You will find opportunities in those other asset classes too. If you start getting into very unusual things, you have to go create things in a custom manner, and that's a whole different ball of wax. But yeah, you can certainly find managers in every asset class.
Yeah, the growth has been explosive, and if you think about where alpha comes from. I mean, you've hit on a number of points where if you were to source a particular fund or a manager, whether it's directly or indirectly, you could probably source their alpha to, innovation and really kind of doing the right thing.
So it depends again what you're trying to accomplish. You can create a passive strategy, as I said, excluding certain sectors that are objectionable to you. Like you could take out private prisons from your portfolio. You could take out gun manufacturers. You could, any sort of number of things of that nature, and still create a portfolio that will have a high correlation to the benchmark. That would be a passive approach that is at least values aligned for you. A different approach might be to take those things out because you think they're going to underperform and not try to rebalance to the benchmark, but just let the rest of the securities go in their sort of overweight. And that would be an alpha seeking strategy. So that's a different way to approach it. It's also values aligned, but it's also, in that case, alpha seeking. If you think that these poorly run or unsustainable business models will eventually pay the price for that through poor security performance, as what happened with the coal industry. I mean, so using coal as an example, there were coal companies in the S&P 500. If you had an aversion to coal on a moral basis, values aligned basis, you could have screened out coal, but otherwise rebalanced the portfolio back to track the benchmark very closely. That would have not led to any outperformance for you when coal collapsed as a sector. But if you took coal out of your portfolio and you didn't rebalance towards the benchmark, you said, otherwise, let's track the benchmark, you would have had some alpha in your portfolio because of the collapse of that sector. So it's a question of whether you think these things are going to play out in a time frame that you're comfortable waiting on from a financial perspective, or are you just doing this from a values alignment perspective? And so it's important to just understand what you're after at the outset with that. But if you're willing to, and there is a long run, short run disconnect, which I mentioned earlier, I'm sure there were points in between the time when coal was king and when coal collapsed, when coal outperformed the rest of the market, but over time it didn't. So if it's a short run, long run disconnect sometimes with these things. But we do believe, though, those of us who have been in this space for a while, that the long run will win out eventually, and you're better off not trying to, or just go with your long run expectations.
I think we have a question, so we'll cut to our question, Gal.
Awesome. Allison is asking, I would like to make sure that none of my money is working against my efforts to bring about the clean energy transition. I have moved everything out of mutual funds with fossil fuel investments, but am having a harder time with banking, especially for a money market type account. Do you have a tip?
For money market, yeah. So unfortunately, banking is one of the prime issuers of the very short-term securities that make up most money markets. I guess I feel a little awkward giving out specific investment ideas on this kind of platform, but I will tell you that there are money markets out there that are, for example, U.S. government-based, not corporate. So if you go with a U.S. government-based money market, for example, they won't have the corporates in there at all. And if you think about too, like money markets you can also substitute, depending on how long you're planning on keeping that cash in cash, with interest rates where they are, it almost doesn't matter where you have it. I mean, nobody's paying anything for return for sort of those safe cash assets. But even when they do pay, when rates were coming up until just recently, you could get competitive rates from your credit union locally or other credit union types of banking entities or CDFIs. Those kind of institutions are really good at having high social impact because they recycle the money back into your local community more so than the giant, Wall Street banks. So if you're comfortable keeping some money in your credit union rather than or a community development financial institution, CDFI, which please, I'm sure Walter can share more information with you about what those are in the future, but those are very effective for having very positive social impact and really supporting local communities more, and not just kind of buffering up the balance sheets of the big banks.
Phil, my question is, where do you see the investment community today? Obviously, the money managers are scrambling, but the investment advisors, are they embracing this? I've talked to a few, and quite frankly, I've been surprised at their responses. More like, you know what, we don't see it. We there's not enough data. We don't want to lose our clients by sticking our neck out and suggesting something that's going to underperform. What do you see?
Yeah, there's a lot of mythology like that in the financial advisor world, and it's extra work for them to engage on these things at times to no additional fee revenue for them necessarily. So it's sort of understandable why many of them would be hesitant to try to have to do more work for the same amount of money. But it's a client-driven thing. I think it should always be doing what you're, doing the best for your client. And if you ask your client, do you care about anything? Like, is there any value that you carry in your life? Of course, the answer is going to be yes.
Yeah.
So people care about a lot of things, a lot of important things. And, part of the reason that we have so many systemic challenges right now is because too many people have not taken the time to demand that their financial advisors get better at this work. I mean, just to put it really bluntly. And it's not hard to get educated in this space. The project that I recently launched that you referenced at the top of this, my introduction, which was a very nice introduction, I thank you, is something called Impact Metropolis. And Impact Metropolis is a free to use resource. I welcome all asset owners and financial advisors and anyone who's interested in impact investing or sustainable investing to just go there and start taking a gander at some of the resources. I mean, this idea that you're going to underperform by engaging on sustainability factors is nonsense. It's not true. And yet advisors like to sort of throw that out there. To me, it's a lazy excuse to not do the work on understanding what their clients really care about and figuring out ways to make sure that their clients' capital is invested in a way that's in alignment with their clients' wishes.
Yeah, and I think you bring up a great point. And next week, I'm going to have 3 or 4 investment guys in here. And so they'll get this, they'll get their question. But you got to, from a client standpoint, a lot of them are structured as a investment factory. They got a system and a process, and to deviate from that based on this pivot, because this feels very different. I mean, this feels like it's a groundswell of I want to align. It's why I loved calling the summit the Sustainability Summit, and I was super focused. What about when you look at ESG? There's a lot of stuff in the press around privacy and social media and sharing our locations and our information and all of that. Where does that fall in terms of is that a governance issue?
Yeah, so I think one thing that the field has gotten a lot more sophisticated about as well, Walter, is understanding what are the material issues for each company or sector independently from every other sector. So it's not the same for everybody. Like the way banks act or the things that sustainability investors might look at when it comes to banks is different than what sustainability investors might look at when it comes to technology companies. When it comes to banks, if banks are financing oil pipelines that are destructive to the environment or drilling in the Arctic Circle, which is just going to exacerbate climate change, for example. I mean, of course, they're all pulling back from that now, or most of them have. That's the kind of, but they did that because of shareholder pressure, and they did that because of investor pressure, and not just being lazy and saying, oh, well, we have this process and we just can't deviate. I think people have to look at the world and understand that they are making impacts with the investments that they're currently making. And, if they don't take a look, they're just leaving it up to other people to decide what those impacts are going to be. And if there are other people are going to decide that, they're comfortable with certain impacts that you're not comfortable with, well, then you're not, on the same page with those people. And so that's when you have to start demanding better from your advisors and from your asset managers to make sure that your money is carrying out your wishes in terms of all of it, in terms of return, in terms of risk tolerance, and in terms of impact. So to be specifically responsive to your question, though, technology companies do have a problem when it comes to data privacy. And they also have a problem with, the sustainable sort of evaluators of data, when they look at technology companies, they look at things like, are they supporting repressive regimes? The face recognition technology is one that some repressive regimes are using to identify protesters in their streets and using that to quell protests, to put down democratic reforms in those countries. That's a problem. Data sharing or having your identity and your, I'm sure you've been creeped out by this like every other person who's used the internet. If you look at an ad for something on a website, or you click on an ad, and then the next thing you know, you open your Gmail and there's like 5 ads for that same product. That's kind of weird, right? Like that feels like you're being watched and tracked in a way that's you didn't approve, and you're certainly not getting paid for. It's one thing if you decide to sell your data for use by consumer, packaging or consumer following services. That's one thing. But if they're just grabbing your data without your knowledge or really your informed consent, that's problematic. But that's different than what the banks are doing. That's different than what healthcare companies do. So understanding what kind of sustainability goals you have with each sector or what's material to their future financial risk profile, so that's another detailed part of the work that every asset owner doesn't have to do every piece of this work the same way that they don't, for traditional financial metrics. Like as an asset owner, you're not going to necessarily look at the return on investment of every single company in your portfolio. You expect your advisor or asset manager to do that kind of work. It's the same with the impact field. You can hire managers who know this stuff and will be active doing this kind of analysis for you if they're good at what they do. But you have to just demand that you hire managers who have that intentionality and are in fact good at what they do.
Let's segue for a second. We got about 10 minutes. And so while I got you on here and you're way smarter than I am, Tyler, throw on kind of our list of where we're at on the slide right now. So Phil, we're just gonna you and I banter back and forth around products and just kind of highlight, the way in which people can invest, whether it's a mutual fund, an ETF, a separate account, or, individual securities. We've already covered life insurance, but, I show this slide that it can be an overwhelming maze of choices that the investor has, and so I'll put this up, and then we'll go back to you, Phil. But there's really 5 things that you always ask yourself when you're moving into a product, and one is the management. And Phil talks a lot about the ESG screening mechanism and hiring somebody to do that. The taxation, what's that? Because you're going to compare, an exchange traded fund versus a mutual fund versus individual security in terms of, who's the manager? Is it you or is it a professional manager? What's the tax? What's the cost? What's the control? Sort of what's the liquidity? So these 5 things are very universal, really throughout every strategy. So now I know that this is a lot of times depends on wealth and size. Small investors will do one thing and big investors will do sort of something else. But tell me the fundamental difference between a mutual fund and an exchange traded fund.
Well, a mutual fund is an is the technical term is open-ended fund, which means it's a large pool which accepts money in and sends money out once a day. So it only trades once a day at the end of the trading day. You can't buy them and sell them during the day. It is a diversified pool of assets that you buy into, and it's usually managed. Sometimes they can be passively managed. That is, not with active management. I guess you've already covered the active and passive
Just
difference, Walter.
the selection process. Yeah, we went through beta alpha R squared Sharpe ratio. So these our participants are ready to go.
Okay. Well, I'd say the biggest difference between a mutual fund and an ETF, in my mind, is that the ETF trades all day long, and you can trade it like a stock, whereas a mutual fund only trades at the end of the day, and so you just have to, you just buy it or sell it. You can put your order in at any time during the day, but it won't be executed till the end of the day.
How about the taxation between the two?
Well, ETFs tend to be more tax efficient because they don't trade that much. They're just following an index. There are active ETFs now, and ETFs are getting a lot more exotic, but the traditional sort of biggest ETFs are just index trackers, which means they buy the securities in the benchmark, try to just match the benchmark as close as they possibly can, and don't trade. So because of that, there's very low turnover and therefore very low tax exposure. An actively managed mutual fund, by contrast, should have a manager trading pretty much consistently. Like, you don't want them over trading, day trading, but you do want them taking positions that would justify their active management fee, which means having an opinion and expressing that opinion through their choices. That means, whether they want to be exposed to the market or, less exposed, or go more value or growth, those kind of decisions. So that entails more active trading. There's another factor with mutual funds you just have to be aware of, which is that mutual funds each one is a pool that has had a life of its own prior to the time that you bought it and will go on after you sell it. So if you go ahead and buy into it and then they decide to pay out their capital gains at the end of the year, they may have taken capital gains during the year from securities that they purchased 5 years previous. If they had if they bought Tesla 5 years ago and then they're selling it this year and they've got huge capital gains, and you only bought the fund this year, unfortunately, those capital gains get passed through to you. So it's a risk if you're in a taxable account, just to watch out for with actively managed mutual funds, that they could pass on, capital gains to you that you were not actually there to personally achieve.
That would be a bummer. I know that those taxation gains are oftentimes, and they're distributed at the end of the year. So when you're towards the end of the year and there's been volatility and a lot of cash flow in and out of a particular fund, you got to be super careful. So it just seems, I don't know what the fund data flow looks like, but ETF, just because of their simplicity, because of their tracking, they're attracting a lot of money. So walk us through the danger of trading an ETF, kind of the bid-ask spread, and what participants need to understand about how to buy an ETF versus how you buy a mutual fund, and what the inherent danger is.
Well, I'm not a fan of short-term trading to start with. I just think it's more or less gambling. And if you're going to gamble, you might as well go to Vegas or Atlantic City or Macau or someplace and gamble. For your investments, you should take a longer-term approach. That's my view. So I wouldn't really advocate just sort of, even though you can trade them all day long, I don't believe that's an appropriate thing for most people to do. Just to try to outperform the market over time. ETFs are diversified pools as well. And as I said, they've gotten more exotic. And sometimes ETFs are tracking very narrow, not actively traded benchmarks. It could be just the Korean stock market, South Korea, or just emerging market high yield, or, very, very thin slices of the overall financial, marketplaces. Some of those are not very actively traded, in general, just that there's not a lot of trading going on every day. So you can imagine when things are not actively traded, that causes the so-called spread to expand. And that's sort of, think of your house, for example, like your house, if you own your house, that's not an actively traded security. You can get an appraisal on your house to tell you how much it's worth on any given day. But if you go to sell it and you're in a hurry, or you're desperate to sell it for some reason, you may have to really cut your price in order to get the thing sold. And if you're looking to buy, if the market's sort of, very attractive and sort of hot, it can cost you more than the current price to make sure you land that purchase. So either of those things happening caused the spread to widen. And this is what happened in the '07 crash, was that a lot of pooled vehicles were filled up with not actively traded securities. And so when everybody sort of rushed to get out the door at the same time, there wasn't enough depth of purchase sort of ready to happen. And that caused the spreads to widen to the point that these things just went under completely. So you do have to be careful not to put too much money into any one sector or security or even an ETF or fund, without understanding what the potential volatility is of that vehicle, how spreads might widen in different market conditions, whether you might be prepared to hold on through a bad market, or if markets go sideways or down, whether you might be prepared to add more if you think it's a really good long-term investment. So it's better to have a good long-term plan around diversification and a combination of assets that will help you achieve your return goals within your overall risk tolerance.
Phil, thank you. So appreciate your time. This has been a phenomenal discussion. I think that this ESG movement is very dynamic. It is incredibly timely in terms of the conversation around what's been happening around the world. So thank you so much for being on the summit.
My pleasure. Thank you for having me.